Well, good morning, everybody, and thanks for joining us. My name is Ben Brown. I work at Ohio State University in the Department of Agriculture, Environmental, and Development Economics, which I do realize is a mouthful. But today we're going to talk about, or this is continuing the Ohio Soybean Council's webinar series. Today we're going to talk about the state of soy and what farmers need to know this year as we progress through the growing season. But before I get started, I'd like to turn it over to Kirk Merritt, the Executive Director of the Ohio Soybean Association and Ohio Soybean Council, for just a couple of remarks, and then we'll get started. Kirk?
Thanks, Ben. I appreciate that very much, and I want to thank everyone for joining today. On behalf of the farmers who lead the Ohio Soybean Council, I want to welcome you to today's webinar. The Ohio Soybean Council board is made up entirely of farmers who volunteer their time to wisely invest the soybean checkoff on behalf of their fellow farmers. As part of that, we present information like you're going to hear today. Really looking forward to Ben's presentation. He does a great job. I always learn something from Ben. And I think it also is important to acknowledge our partnership with Ohio State University overall. Our work with Ben is a good example of that, but we also work with OSU in a lot of ways, including a significant program of research on soybean yield, pest, disease, nutrient management, those sorts of things. And just real quick, on a separate note, I want to mention that the council's sister organization, as Ben mentioned, the Ohio Soybean Association, works hard to advocate on behalf of farmers, soybean farmers. In the last several days, we've been really focused on trying to ensure that farmers have access to dicamba. Late last night, US EPA provided some clarity that I think does give farmers access for the current growing season for the most part, which is good. But we do still need to address that issue for the long term. And this is a tool that farmers need in their toolbox. So we'll keep pushing on that longer term, advocating for that access. With that, I'll turn it back over to Ben. Thanks, Ben.
Thanks, Kirk. Much appreciated. I just want to extend I know Kirk gave thanks to Ohio State, but we really do appreciate the work that our commodity groups do around the state of Ohio. I have a lot of respect for Ohio soybean farmers and just farmers and producers in the state as a whole. Most of you, or those of you that know me, I grew up on a farm in western Missouri where my family still farms today. And about this time of year, I get a little homesick, wishing I was home in the field helping with planting, especially when we start wheat harvest here in the next couple of weeks, because that was always one of the highlights of my childhood. But then even harvest in the fall. And so I have a great amount of respect for Ohio producers of all types, but I also have a lot of respect for our commodity groups, and I just want to say that the Ohio Soybean Association and Council both have not only some really great professional staff, but they're just really great people as well, and I'm thankful to call them friends. And I just want to echo what Kirk said. Their staff does an amazing job for the producers of Ohio, and we're very appreciative of their partnership at Ohio State as well. So with that, I'm going to dig into my webinar. We're going to go through a couple of things relatively quick, but I have a couple of parts and highlights I want to touch on as we move through this. As always, you can submit questions into the chat box in your little GoToMeeting chat room. We will get to those. Alex is going to relay those to me, and we'll answer the ones we can live during the presentation. We'll follow up with any remaining ones we have at the end of this before our hour is up. And then any that we don't get to, if there's more than I get time to, I will make sure to get those answered and back to Kirk and the folks at Ohio Soybean, and we'll get those out to you as well. So with that, let's just dive in. And I just want to start off and talk about, I put this presentation together, and first off, it's hard to do a market outlook just in general when in the summer months when so much is dependent on weather, and that's where we're at right now. And it's challenging to say the least when I don't have all the weather models to know, okay, are we going to get rain in the next 20 to 14 days, or is it going to be dry in July? Is it going to be dry in August? I kind of rely on my colleague Aaron Wilson. Aaron does a really great job for us. But it's hard to do weather outlooks. However, the economics is something that I'm pretty good at, taking a a weather forecast from these big firms that do weather forecast modeling, taking the production carryout, and then doing some economic analysis based on the size of that crop in terms of how much we're going to use. And I feel like I'm pretty good at that, but this time of year, it's all hingent on that weather market. And I'll be upfront, there's some pretty bleak news at least in the long-term outlook for all commodities, just as a result of COVID-19, but even some lingering trade disruptions, and then just challenges with demand and demand shocks due to income effects as well. And we'll talk about those as we go. But I've tried to put some highlights and some positives in this, not to paint overly a rosy picture, because it's certainly not the rosiest it's been in the last decade. But I try to find some positives, and I've been reading this book, The Pioneers, and I am certainly not an endorsement or endorser for the book, and I don't get any royalties for talking about this, but it talks a lot about, if you haven't read this book, it's by David McCullough. It talks about how the first pioneers that came in and settled Ohio and what they saw when they were settling Ohio. And I'm reading it right now, and it's been one of the most uplifting books, not being from Ohio, but being very involved in agriculture, to hear what the settlers saw when they came to Ohio. And I've just thrown this quote up there, but again, it's just a reminder of when people were coming to Ohio, the joy and the excitement they saw as they were settling here. So again, it's helpful to find just some stress release from time to time. I know it's been difficult the last couple of months. I'm certainly not a counselor, a mental health expert by any means, but we do have resources available, and I would just encourage people to find things to help them relieve stress, even for us here at Ohio State too. So with that, today's agenda, we're going to talk a little bit about marketing opportunities for both soybeans and corn, a very brief and short outlook. As I mentioned, I try to do my best at this time of the year. It's so much dependent on the size of the 2019 or the 2020 crop, and we'll talk more about that as we go through. We're going to move to federal aid and policy expectations. Basically, there's a lot of policy options available to producers right now, probably more than we've had at one point in a long period of time. And so we're going to talk about a couple of things, and then we're just going to wrap up and evaluate future budgets and working capital considerations as we move forward. So let's start off with the soybean fundamental outlook. And I can't take credit for this concept. This is a concept that I saw from the good folks at Intel FC Stone. We have a Bowling Green office. They do some really good work here in the state. And they use this concept to basically evaluate long-term, short-term, bullish and bearish fundamentals. And I really like the concept. I've kind of taken this. There's really not a whole lot of statistical ground to this. It's just pretty much what we see and what I'm evaluating in the markets right now in terms of driving them both short-term and long-term. And there's a couple I want to point out, but we're going to talk a little bit more in depth about all of these. First thing is global growth is definitely something that's hanging out there as a very bullish long-term factor. And we'll look at soybean demand in the next couple of slides on a global scale. But when we look at the population growth we've seen around the world in the last couple of years, and then just the amount of demand of protein products and animal meat products, as a result of that growth is very supportive to soybeans in the long run. So I think global growth is out there. Now we have to balance that with short-term growth, right? We can't all of a sudden say, hey, we need to double our food production today when global growth isn't growing as fast. And so that's sometimes our challenge is short-term supply and demand get a little out of whack. I think this China trade deal and China just with trade in the long run is something that it's maybe a little bit of a mixed bag, to quote a colleague of mine, Barry Ward, in terms of how we look at some of these things. In the short term, I think China trade, definitely there's some challenges there, but given what they need and their challenges with African swine fever and how they're going to rebuild back their herd, I think that's both got some short-term and long-term issues, but overall I see it as being a longer-term bullish factor. And I think it's going to be something to where we'll have to continue to watch to see how much trade diversion just goes to China and then we take from other places around the globe. Is it increasing the whole pie, or is it just increasing that piece of the pie? And I think it's going to be quite a bit of trade diversion, but I think we could see that pie increase in total as China continues to grow and increase their trade. Some of the bearish short term is definitely our growing stocks. Now, granted, we took quite a bit of our stocks out of the picture last year. It was last spring, January, February of 2019, and we were talking about 1 billion bushels of carryout in U.S. soybean stocks. And we basically shocked that all the way down to 450 million bushels as a result of we took a lot of soybean acres and we couldn't get them planted, and we turned them into prevent plant. While it was, not a pretty situation for planting across the Corn Belt, I always like to say one of the bright spots is we fixed a problem we had on our soybean balance sheet, which was really large stocks. We had built supply out of the demand realm. Another big bearish factor is African swine fever, I think, in the short term. Now they are growing that, back, and we'll talk a little bit more about African swine fever, but it is something bearish. And I think it's a pretty big factor in the bearish short term. For soybeans, now for U.S. pork, that's a bullish thing because hopefully we can continue to export strongly into international markets and especially into Southeast Asia. U.S. acreage is something to just keep in mind in the short term. It's a little bit bearish, but we're a lot closer to being neutral in that. Just from the standpoint of we took so many acres out of production last year, we're certainly not. How do I want to put it? We haven't brought all those acres from last year back into soybeans this year. We were a little bit more moderate, and that's helped sustain a little bit of the prices we had. If we'd come back with 90 million acres of soybeans, we'd be looking at a pretty low soybean price right now. The dollar has come down, which is a positive that allows our goods to compete more easily on the world market. And then the funds positions are, in a way, oversold a little bit, or we could see a little bit of pressure on the funds, and we've seen that the last couple of weeks as some of these people left their short positions and started buying, and that put a little pressure on the market as we moved through the last couple of weeks. So just real quick, looking at the global soybean picture. So what I've got here is a couple of regions around the world, the red being South America, Paraguay, Brazil, Argentina, the gray, the U.S., East Asia, there in the light blue, and then the rest of the world there in purple. And you can see that global soybean production is really dominated by the Western Hemisphere, the United States and South America. While this year we're seeing a new record production at 363 million metric tons, I will point back to last year. We saw that dip in 2019. I had pretty much gone around the state of Ohio saying, hey, we need a production shortfall somewhere in the world to help support these prices. On the back end of it, I kind of joked and said I should have been more clear and asked for a production shortfall somewhere in the world besides Northwest Ohio. But if you look at it, almost all that production shortfall came from the United States. We've rebounded really nicely this year, both here in the United States and in South America as well, to a new record expected production for this year. So that's something to keep in mind. The positive thing is global soybean demand has also increased at a pretty significant clip. And what I'm showing you here is up to the 2019, or the red line represents 2019, and then you can see our forecast, or the forecast moving forward. China is expected to continue to consume and be a dominant consumer of soybeans, both U.S. and around the globe. And I think that's an important thing for us to consider, that if we really want to continue to build our demand for soybeans, one of our primary markets is going to be that export market, and especially the Chinese market. It's a powerful market for us because we can sell competitively into that, especially if we're shipping out of the Pacific Northwest, especially for soybeans, but we can send them lots of soybeans at a time, right? We're not trying to pick up some of these smaller markets that, while important, it just creates a little bit of extra work. So that's kind of one of the nice things about China, and I think we'll continue to see growth there. Maybe not as strong as what we had. I think we're going to move forward with a more diverse portfolio over the next couple of years, but still a very positive news. Not only are we seeing record soybean production, which again, it's that whole long-term supply and demand versus short-term supply and demand, but I think at least if you look long-term at the domestic demand, or the global demand for soybeans, we're continuing in this era of really strong increases in soybean demand. However, back to that graph I showed you of South American production, one of the things that troubles me a little bit is the incentive for South American producers to continue to produce soybeans at such a rapid clip. And so what I'm showing you here is this is basically the U.S. soybean price in dollars per bushel in red and represented on the left-hand axis, and then the Brazilian price in Brazilian reals per bushel in the black line and on the right axis. These are the same bushels. Their contract works off the Chicago Board of Trade just like ours, but we have to make a currency valuation or exchange. And because of that, Brazilian producers are continuing to get the signal to produce more soybeans. This is an incentive to produce more soybeans. And you can see it's come down here the last couple of weeks. As the Brazilian real has weakened or strengthened compared to the U.S. dollar, helping us on the international market in terms of selling U.S. soybeans. But just even from an incentive for next year's production, bringing that back down is helping to bring this incentive back in line. But if you're a Brazilian producer and you're looking at this, the first thing you're noticing is, gosh, price continues to go up. I'm going to continue to lock in this price and increase production the next year. And if I went back to the graph I showed you previously, this is a big part of it, is the market incentive here in the United States continues to be flat or down when you look at a dollar per bushel. And keep in mind, this is not taking into account cost. But when you look at Brazilian producers, they're getting the strong market signal to continue to increase production. So just something to keep in mind. Looking at U.S. soybean production, this is year over year changes in million bushels, and so you can definitely pick out the drought years. Last year, a big loss, almost 900 million bushel loss in production from 2018. Now, I like to look at this and say we were kind of looking at two extremes. 2018, 2019 was a pretty good year. In fact, it was a really good year in some parts of the country, like the Eastern Corn Belt. So we're looking at a good year versus a really bad year in terms of production. That makes this drop of 872 look, extra extreme. But we're rebounding some of that back this year, picking up 568 million bushels more this year than what we did last year, and that's a positive. And so I think from a soybean perspective, when we look at these soybean acres, while I was expecting a little bit more soybean acres than I think we're going to end up with this year, we're going to be right in line, pretty close to what I had anticipated going into the year. Once we take into account, I think we've seen some acre shift from corn to soybeans here in the Eastern Corn Belt, just given market fundamentals. So that's our production and supply side. A couple of things I want to point out on the domestic side of the market. Soybean crush, and again, these are provided to us by the National Oilseed Processors Association, has been on a tear through this year. And I'm showing you 2019. So if we're looking at the left-hand graph, that red line there represents 2019, 2020 soybean crush per month by those NOPA agents, or those NOPA members that represent about 95% of the U.S. soybean crush. And keep in mind, the marketing year for soybeans runs through September through August. And so already this year, we've had 8 months of soybeans reported up to April. We'll get May here the 15th of this month. But when we look at this, 4 out of those 8 months have broken new all-time records. And we're, the last 4 months have been above our previous range over the last 5 years and 2018, 2019. So we've had really strong soybean crush values. Part of that explanation is explained in the right-hand graph, which is daily soybean crush margin. So this is taking the margin that soybean crushers, think Cargill and Sydney, just as an example, since they have a pretty large soybean crush facility there in Cargill, Sydney. And again, I'm not trying to just isolate them out. It's just that's an example of one. You would take a whole soybean, how much you'd pay for whole soybeans, and then it's a ratio of what you can get for the soybean meal and the soybean oil based on futures prices. And so that's what this graph is really looking at, is what is the margin or the incentive for those soybean crush facilities to increase soybean crush potential. And as you can see, we had big, strong soybean crush back in 2018. That was a really strong year of gain for the soybean crush industry. A lot of people decided to expand during this time. That's where we got the announcements of several big expansions in soybean crush. But then just here over the last couple of weeks, we've seen this big, strong increase. So the back end of March, first part of April, we saw that strong increase in incentive for soybean crush facilities to increase soybeans or crushing soybeans. It has since come down and we've leveled out. So, looking forward at the next couple of months, I would expect May to be somewhat strong, but not near as strong as what we've seen the last couple of months. And I think through the remainder of the year, we're still going to remain strong. And I look for us to set a new record annually in soybean crush. But March and April were just phenomenal soybean crush reports. And keep in mind, it was based on this incentive that we saw back here in March and April that really helped us get there. So when we look at domestic soybean crush, and my expectations as we move through the remainder of the marketing year is, this is annualized, now turning those monthly soybean reports based on seasonal trends into annual adjustments, or trying to estimate what the annual number is going to be at the end of the year. Currently, USDA is at 2.125 billion bushels of soybeans crushed. That's a strong amount. That's about 7% over what we did the prior year. based on the numbers that we've seen in the last couple months, including April, that our trend seasonally adjusted would suggest to us that we're closer to 2.146 billion bushels of soybeans crushed, almost 20 million, 20 million more bushels crushed than what USDA is expecting. I don't think we'll see it. As I mentioned, this is taking into account what we've seen based on previous months and adjusting it for an annual number. I expect the next couple months to be strong, but not near as strong. So I think we'll come back down from that, maybe about 10 million to just 10 million more than what USDA is estimating, but 10 million more than what I've got there represented in April. And I'll show you that in my summary when we get to that here in a couple of slides. So what was driving that soybean crush, and what drives me to say that I don't expect it to be as strong moving forward? Well, there's really a couple of key reasons. The first reason was we saw some logistic issues as a result of COVID in South America, especially in Argentina, a major soybean meal exporting country, and they were having some challenges getting soybean meal out of Argentina. There was some, ports that were locked down. The government restricted producers to bring soybeans to the ports, and so we saw a logistics issue that really brought extra demand to the United States. The other issue that came about was this whole area of the intersection between grain markets and soybean complexes with livestock, and I don't think there's any doubt that livestock is a major user of ag products. And as a result of some of these slaughter facilities being shut down earlier this year as a result of COVID, we saw, I'm showing you pork here, but I could show you almost the exact same concept on the beef side. We saw a rapid drop in the amount of federally inspected hog slaughter, same on the beef side. And I'm using a 6-day moving average here, basically to take into account weekends and holidays. You still see some of the holidays. So like this big dip down here, that's Memorial Day weekend, 4th of July here on the next one. But long story short is, we saw a 43% drop in hog slaughter. We saw a corresponding drop in beef as well. It has since recovered pretty nicely. And we are slaughtering animals back up, getting pretty close to, if not at, pretty close to our normal rates. I will remind us all that it's one thing to catch up and maintain a rate. It's another thing to start working through that backlog of animals that we've got sitting out there on feed or on grass in the case of cattle. And so that's something to continue to watch. But the other thing, I guess, to translate this to soybeans is this picture now paints a picture with cheap feed, slaughter rate getting closer to levels like what we saw. It actually raises the incentive to add on those extra pounds that are typically, inefficient, right? And so there's actually an incentive to feed weights out a little heavier. Now, grant, we already had heavier weights as a result of we were holding animals longer, but now we actually have an incentive to feed those animals a little bit heavier than we normally would. That's a positive for grains when we look at that. So we had the big drop off in logistics. It's coming back. So I think we'll still see some positive feed meal, whether that's bean meal or DDGs or whatever, as we move forward, kind of as a result of fixing this back up. Long term, when I look at the animal picture, a couple of things that do concern me is while boxed beef and pork prices have been coming down as a result of this slaughter picking back up, prices are still elevated at the retail level, or in terms of product, both at the wholesale coming off the line and at the retail, they're still elevated a little bit. Plus, we've got a huge income effect that I don't think any of us really know how to categorize. And that income fact is, while we saw really good job numbers in May, we still got about roughly 39 million people that were laid off, furloughed, or temporarily released from their job in the last 10 weeks. And as a result, about 40% of our workforce was without some form of pay over those weeks. Now, I'm putting pay kind of as a cautious term because several of them were receiving unemployment benefits. So, they were technically unemployed, but they were receiving unemployed benefits. The question I have is, what does this all have to do with buying power of meat and pork and beef later in the year? And I think that's something that's concerning to me, is we could have a scenario where we have an income effect that's lowering demand for meat products while increasing, even with elevated prices. And so I think that's kind of a negative for the livestock industry as a whole. And when I look a little bit medium term over the next year to 3 years, I think we could see a contraction of both beef and pork industries here in the United States. Looking at African swine fever, obviously that's been a big issue for the global pork complex, but even soybeans a little bit. We saw strong cases, and I'm showing you here reported number of cases per month in Asia and China specifically. And you can see we saw those huge numbers, reported cases per month in 2018. Then we kind of dwindled, and we didn't have any for a while to start 2020. But we've since picked up a little bit. Plus, we've seen other outbreaks in Poland and Eastern European countries. And then China just last week announced the ban of all pork imports into China from India as a result of India having, outbreaks of African swine fever as well. So we're not behind us. This is not behind us, and I think that's the counter to what I just said on the livestock. When I talked about, we could see a decreasing sector, here in the United States. The one counter to that is our exports of pork globally have been fantastic the last couple of months, and we're going to need those to continue to help support pork prices and pork farmers, which then ultimately triggers down into soybean demand, soybean meal, and soybean prices for soybean farmers. The other thing that drove, kind of that blip that we saw, and is something that I think is going to be interesting to watch moving forward is the use of biofuels. Ethanol obviously is our most common biofuel, but biodiesel is growing and is an important biofuel product as well. Once the EPA, Environmental Protection Agency, sets a percent standard in terms of what percentage of motor fuel contains biofuels, the driving factor of how much biofuels we consume is finished motor gasoline demand. And that's what I'm showing you here. The red line is 2020, and you can see the big drop off, about 46% drop off in motor fuel demand. It's picked back up, and we've seen growth. My forecast is there on the blue line, so I don't think we're ever going to get back to full driving. I think there's just a lot of people that are really happy working at home. I'm not one of those. I can't wait to get back to the office, but I think there's a lot of people that are really happy being at home. Some people are concerned about getting out. I think we're going to see less activity driving around, going to restaurants, movies, stuff like that. So it's something to watch, and I think as a result, 2020 will see about 11% decline in annual fuel demand. We're expecting the RVO, or the Renewable Volume Obligation Report for 2021, to be released any day now. We've been saying that for about a week, 2 weeks, but really we could see any day now. And that's going to have big impacts on biofuel use, ethanol and biodiesel, which is a product of soybean oil, as we move forward. And it's really highly anticipated. I don't want to spend all the time going through kind of the logistics, and I think the stress or the pressure that US EPA is under, because basically we've got a couple of factors that could really throw this out of proportion if not done correctly. So that brings us to our first question. I'm going to have Alex throw up the question. Basically, what I want to do here is just kind of interact with you and break this up a little bit. I've got a couple of poll questions sprinkled throughout this. So Alex is going to put the poll up here. And basically, the question is, driving in my community is back to what percent of pre-COVID levels? And I've got a couple of different breakdowns there for you. In terms of they're basically 10 percentage breakdowns except for the last 5%. And if you wouldn't mind answering those polls, and then Alex, I'll just let you tell me when you feel like we've got enough responses to share. But the idea here is, I'm estimating, we get back close to, or we have about an 11% drop in annual fuel use, motor fuel use, as a result of COVID, and I'm just trying to gauge how close I was to what's actually happening out there in the community. So this is as of this week. What do you think the percentage of normal driving is happening in your communities? And we'll just give you a few minutes to answer, and then I'll have Alex put up the poll results when we get there.
Okay, then I'm going to close the poll now.
Excellent, thank you.
And then I will share the results.
All right, so it looks by far and away our number one answer is 65 to 75%, which is about what I showed in that previous graph where I was estimating fuel demand is somewhere in that 65 to 75%. I think it will pick up here in the next couple weeks as we, it's nice and people start driving again more, but that's actually maybe a little bit less than what I was expecting, but not too far off. So thank you, appreciate it. Can we go back to the slides? Excellent, cool. All right, so let's look at soybean exports. This is the one that I'm maybe the most concerned at the current moment when we look at demand for soybeans. I think one of the big issues that we've seen is as a result of kind of this uncertainty that's been put into our export markets, is the whole, will China follow through on its phase one commitments or not? And I think that's an important question to ask, and certainly there's a lot of people that are, analyzing that decision and spending a lot of thought on it, as a result of, just even political pressures in other parts of the globe. I think they provide uncertainty into this mix of, will China meet their phase one purchases or not? Right now, what I'm showing you on the left-hand side is United States soybean commitments of the same period every year. So this is September through the last week of May. You can see China and then the rest of the world there. This year, commitments to China have been up from what they were last year. We're still way below what we were in 17, 16, 15. But as a total, our soybean commitments are down. At this point, we're going to need to see really strong soybean purchases and shipments through the remainder of this marketing year through August to get even close to not only last year, but back to the pre-ASF and pre-trade war kind of era there in 17 and 18. Again, this is on a volume basis, not a value basis. So I'm just looking at specifically bushels sent. Obviously, soybean prices have come down. It becomes cheaper to buy them, so we'd expect more on a volume basis than a value, but still we just haven't seen that transcend. When we, on the right-hand side, this is a chart provided by Intel FC Stone, and they track, the seasonal pace needed to meet USDA's current estimates. We're about 6% below where we need to be to meet USDA's current estimates, and again, I'll show you this when we kind of wrap it all up. But and very disappointing on the soybean export side, and really the reason why that's the case is, looking at U.S. and Brazil as the major producers of soybeans on a global basis, we're also the two largest exporters. And what I'm showing you here, I got this from Karen Braun, but we used to trade off and on. U.S. would sell during our harvest into the early winter, and then Brazil would pick up and supply China after their harvest into the early summer, and we kind of went back and forth. We broke that cycle back in the summer of 2018. Then ASF kind of weakened that a little bit last summer. And so far this year, Brazil has just dominated to lead 2020. And part of that's the exchange rate. The other part of it is Brazil just has soybeans to sell. And there was some tension, again, with the United States and China, to where we got reports that China was telling their buyers not to buy U.S. soybeans. And so, again, these are soybean exports globally. And Brazil has just dominated. Now, a year ago, I think it was just a little over a year ago, I spoke to the Soybean Council as well, kind of in a webinar format. And one of the questions I got was, will Brazil run out of soybeans? And I've got two slides here I want to talk about, are they going to run out of soybeans, and can they continue to supply at this rate? And the first one is based on a report that some folks at Purdue and the World Policy Center did in terms of Brazil's land use changes. As a result, you can see they have taken some pasture out and put to cropland, some forest out and put to cropland, but really the big shifts to soybeans came from other crops, especially in that dominant first crop. And so you can see they've increased, change in land area by about 4 million hectares over the course of this as a result of kind of these soybean tariffs. And so, a year ago when I was talking to you, one of the things that was asked is, can't we just reshuffle the deck around the globe? And as a result, China, buys from Brazil, and then we sell to the rest of the globe. And I kind of responded and said, well, we can, but it's, we're going to lose some market share because it gives Brazil the incentive to increase production. That's what we've seen. They've really ramped up production more so than we probably would have seen otherwise. In fact, I'm 100% sure of that. They've ramped up production more so than we've seen otherwise. And as a result, when we look at what they've got in supply, even though they're exporting globally and their domestic consumption's been good in South America, their carryout really has taken a little bit of a dip, obviously from where it was in 17, 18, and prior. So the last 2 years and what we're forecasting this year in 2020 and 2021. But you look at their stocks use ratio, and it really hasn't taken as huge of a dramatic drop. And that's an issue for me, is I think we're going to continue to see Brazil really dominate in soybean exports because they're continuing to increase production at a rate that we weren't expecting. So just to keep that in mind when we look at all that as we go through. Now, as far as the impact of the phase 1 deal, the image I'm showing you on the right is a slide that I took from my winter outlook meeting that I gave around the state. And basically this little chart down here in the bottom is really kind of what I want to illustrate. But when the trade 1 deal got announced in December, there was a lot of optimism about, hey, we got a deal, things are going to go back to normal. We should see some healthier prices as we move forward. When we got to that January 15th date when the trade deal was signed and we first got to look at it, we found out there was a lot of loopholes in that deal. One of the big ones being that the tariffs were going to stay in place and that China was still going to have to pay tariffs on U.S. soybeans. And as a result, we just saw our soybean price fall back to what it was prior to the trade deal being announced. The other thing that I want to talk about a little bit is the FAPRI group, the Food and Ag Policy Research Institute at the University of Missouri, has put some numbers together looking at no deal or basically not following through with the phase 1 trade deal versus following completely through with the phase 1 trade deal. And we see a lot of trade diversion as we'd expect and as what we saw prior. The big thing, and I guess I don't have it listed, the black bars here are the rest of the world, and then the red bars are China. So again, 2020 and 2021 are next year's marketing year, and then the marketing year after that. And again, red is China, black is the rest of the world. And you can see soybean exports as total increase, but we see a whole bunch of trade diversion. The big key here is that if we reverted back and started supplying China, to meet these phase 1 trade agreements, we would not see the same level of world share because we've incentivized Brazil to increase so much production. And there's just this extra production hanging out there on the market that's going to continue to weigh on our ability to just go back to normal. So second poll question, do you believe China will meet their phase 1 import commitments for U.S. ag and related products in 2020? Again, that promise is 12.5 billion, or the deal is 12.5 billion more than our 2017 baseline. The 2017 baseline was 19.5 billion. So 12.5 billion on top of that 19.5 billion is what we're shooting for. And I've got a couple options: yes, no, but more than 2017 baseline, no, less than 2017 baseline, then unsure. So Alex, if you'd go ahead and launch the poll, I'd greatly appreciate it. And like I said, I'm just trying to get a gauge of I guess, sentiment about the phase 1 import commitments out in the field. We're gonna talk through it, but I wanted to ask the question first just to kind of get where the sentiment is. And Alex, if you'd let me know when we get done.
Okay. And here are the results.
So the majority of you said no, and less than the 2017 baseline, so less than that 19.5 billion baseline. So we're going to go through that in the next slide. So if I could get back to the PowerPoint. Awesome, thank you. So here's where we stand today. This is actual sales of ag and ag-related products from the United States to China. This is from October because these data points are reported on a fiscal year. So this is through October through April. We have April now. The phase 1 trade deal is actually done on a calendar year, not fiscal year. So basically from January to December. But I've just got the fiscal year represented here. The red bars are actual sales and where we're at the moment. The black line that you see there is the seasonal forecast given the sales that we've seen already this year. And then the gray bars are the values that we need to get to USDA's current estimate of 13 billion for the current fiscal year. So we're running below what USDA even needs to get, or what we need to even get to USDA's estimate of 13 billion. Now keep in mind, this is I'm showing you a fiscal year. And the phase 1 commitments are on a calendar year. But I think the big story here is we need shipments to China to increase by at least 60% to reach those trade commitments. even the baseline, the baseline, and then we're going to need even more than that to reach, the phase 1 commitment. So I think I would agree with the poll. Right now, it looks like we're going to come in below the baseline even for the current year, unless we see major shipments in the back end of the year, which again, that brings a whole lot of uncertainty because it brings in a lot of political ramifications. So let me pull all this together for my outlook just real quick. What I'm showing you here is this is old crop, so our current marketing year. Keep in mind we're in our current marketing year through the end of the year. So this is old crop numbers. The first column you see there is USDA's May number. The red numbers in parentheses are their change from the previous April estimate. The new estimates come out this Thursday, so we'll get new estimates this Thursday. And that's what's represented in my column here in the second column. And so my column here captures my changes and then what I think is going to come Thursday. So I'm expecting 10 million more bushels of soybean crush for the annual amount here in June. And then another reduction of 25 million bushels in exports. Both of these numbers I've been kind of at for a while. USDA came to me in a big way this year. I was at laughable numbers because I really haven't changed that export value for several months, probably since February. And USDA kept coming to me. They came to me 100 million bushels and gave me my export value and made me a little bit unsure. And so I ended up lowering it another 25 million bushels this go around. And we get pretty close to almost 600 million bushels of carryout. So that's old crop and what we're carrying into this year. And here's my estimates for new crop. Again, the first column that you see here, this is May. WASDE, what they showed for their first iteration of new crop soybeans here in May. They had 405 million bushels of ending stocks for the year. But a couple of things that I think are really key here is that export value is really strong at just over 2 billion bushels, given where we see soybean exports right now and where they could go. I'm 100 million bushels less on soybean exports. Again, I'm a little bit higher on soybean crush, but my estimate for ending stocks comes out pretty close to where we actually sit today in terms of the old crop carryout. Now I've got some bearish and bullish scenarios that I've thrown in here. The two big changes for both these scenarios is change in acreage. So right now, we're using that 83.5 million acres that was reported in that prospective plantings report. If we gain 2 million acres, this is what it kind of looks to the balance sheet. Or if we just gain, I think we will gain acres. That's why you don't see me leaving it alone or even decreasing, is I think we are going to see some extra soybean acres here in the Eastern Corn Belt especially. And so if we only gain 500,000 acres, here's that bearish scenario in the back, or the bullish scenario on the back column for soybeans. So I guess what I would say is it's easy to get down on 2020 already in terms of market prices, but I will remind you, we were pretty low and pretty negative on 2019 crops last year. And we had that big supply shock due to prevent plant. That really kind of corrected some of this a little bit. Maybe isn't as rosy as what we'd like it to be, but it could be a lot worse today if we hadn't reduced that acreage and yield last year. Same scenario here on the corn side. This is, again, this first column is USDA and their change from their April WASDE. The second column is my column and what I expect in the change here in June. I've got ethanol coming down another 150 million bushels and feed and residual use up 50. I think they'll leave exports alone, even though we are trending below the export value at the moment. When we look at new crop, again, USDA's first iteration of new crop corn here on the first column, and then my three scenarios where I think we're going to be the biggest one to me in terms of where I think USDA might be a little over exaggerated is if we look here at this total production number, we came pretty close to 16 billion bushels of total production and over 18 billion bushels of supply. The big question was, would they print over 18 billion bushels of supply? And they did, but they got a little creative, or a lot creative, on the demand side to help lessen the blow. Look at this feed and residual use number here. That's a huge feed and residual use. I think the residual component is a lot bigger than what we've seen in the last couple of years, and exports are strong. Now, granted, I've got exports strong as well, but they got pretty creative on the demand side, in my opinion. So when you look at my numbers, the biggest difference between USDA and me is really this feed and residual use category here, to where I'm taking the extra that they've they've got in residual, and I'm adding it to the ending stocks number. So our balance sheets aren't that far off. And after USDA released their balance sheets in May, I felt pretty good about mine. But again, I think USDA's got a really high feed and residual use number there, big residual effects. I expect that to come down as we move through the marketing year. And then you can see my bullish and bearish scenarios over here. Again, corn doesn't have a lot of fundamentals. We've come down quite a bit in corn. There's just not a lot of good fundamentals to corn as we move forward. And corn actually could, if all this, goes wrong and we produce a big crop and South America has a big crop, exports don't pick up and ethanol doesn't return due to decreased driving or changes in policy, we're looking at some pretty negative numbers on corn. And so again, not to get totally down because we saw a big change last year, but just something to keep in mind. So I guess here's my key questions and observations from my ag outlook is that, USDA is very optimistic about Chinese global soybean demand. They've got next year soybean demand globally for China 5% above their pre-ASF outbreak levels, but the hog herd remains about half the size it did prior to that. So again, I think they're pretty optimistic when it comes to soybean trade. Domestic corn production came in close to expected, as I talked about, but they got creative on that demand side, especially in the feed and residual category, to soften that blow. The focus now shifts to weather and final acreage. Here in the Eastern Corn Belt, we had some troubles with planting, and I think we saw some changes in acreage out here, especially North Dakota as well. Good crops are expected, but the probability of dryness is increasing. Again, I'm not a weather expert, but that's what I'm getting from the big players. And then will China be a player in the U.S. demand story? If they come in and start buying, lots and lots of products, and especially soybeans, some of this changes. Or if they come in and start buying ethanol, I think right now I'm not necessarily expecting that. And I hate to be a downer. I'm just not expecting them to buy ethanol. They could buy some more soybeans, but we'll have to see what the next couple of weeks and months looks like there. They've been active here as of recent. But again, we're going to need more than what they currently are because they're basically just maintaining, our spread. It's not widening, it's not shrinking, it's just maintaining. But again, it's one thing to maintain it, it's another thing to start picking back up. So we'll have to watch that. And then large crops both domestically and globally on the market. So I guess if I had some characteristics for farmers to look out for and to think about, basis, especially soybean basis for harvest is especially strong right now. So if you haven't started marketing some of your old crop, basis I think is something or new crop basis is something to take a look at. And if you've got old crop corn and soybeans remaining, at this point I think we probably should be moving that through the system, as we have seen some opportunities to market old crop corn and soybeans in some of these ethanol locations, but even some of these soybean basis bids that we're seeing for new crops or for old crop soybeans and corn. So be thinking about it. I would not recommend having much soybeans on hand here in the next week or two at the end of that. And so, we should be moving out of the old crop scenario and start thinking about new crop. And I think there are some opportunities to market new crop, even though the outlook maybe not as positive as what we thought. So we're going to move on to just a couple of comments about policy expectations. And I'm actually going to skip this poll question real quick because I want to get to the CFAP. So if you haven't heard, the U.S. government is support for coronavirus and help farmers aid in coronavirus has announced this CFAP program. The application period opened May 26th and runs through August 28th of this year. There's two components to this program, and that's why when I show you the payment rates here in a second, you're going to see two payment rates. One part is related to the CARES Act that was passed in March and signed by President Trump. The second part is related to $6.5 billion that came from the Commodity Credit Corporation, but that all adds up to $16 billion in payments to farmers. Another way to think about this is if I show you the soybean futures chart here, and this is for July soybean futures. We saw a big drop in soybean futures kind of in that coronavirus period from middle of January to middle of April. That's related to that CARES funding, but then we've maintained our prices really since then. We have seen an increase here in the last couple of weeks, but when this program was announced, we had pretty much flattened out at pretty low prices, and so the CCC funding is really to help provide support due to the low prices. A couple of key details. Eligible producers are those that own risk in non-specialty crops, livestock, wool, dairy, and specialty crops. Crops had to suffer a greater than 5% loss to be qualified for COVID-19. The payments will be split up into two parts. 80% will come at approval of the application, and 20% of the payment will be paid later if sufficient funds remain. There is a payment limitation of $250,000 per family, or $750,000 per corporate entity, because you can have 3 people in that entity. And so those are the payment limitations. You still have to abide by the $900,000 of adjusted gross income over tax years 16, 17, and 18, but you can be exempt from that if 75% or more of your income comes from farming, ranching, or forestry related activities. But then producers also have to comply with highly erodible lands, wetland conservation provisions, like you would for normal farm bill programs as well. So I've thrown the formula up here for non-specialty crops, but I'm going to give you an example. So we're actually going to move past this, but this is the formula for non-specialty crops if you haven't heard. As far as the big thing is, you have to identify your eligible inventory, what you're going to take these payment rates times. And so this was the language that we got from USDA early in the process in terms of what is eligible inventory, what's unpriced inventory, what's subject to risk. The big thing and change I think in the last couple of weeks is they are counting corn chopped for silage. So if you had corn that you chopped for silage in 2019, you can count that as your 2019 production. And if you had silage on hand as of January 15th, you can count that for the corn CFAP payment. So here's the big question I'm getting though, is what type of contracts are eligible for inventory? And so USDA they released some details about which contracts are eligible. If you had a basis contract on that grain, you're eligible. So basically you locked in a basis value, but you did not set the futures price as of January 15th, you can count that grain. However, in the opposite side, if you had a hedge to arrive contract where you locked in the futures contract, but the basis was still left to fluctuate, that contract is ineligible. That's probably the biggest area of disagreement I think I have is, to me, these contracts should have been treated equally, whether a basis contract or a hedge derived, they should have been treated equally. If you're going to put one in one, the other needs to be there too. I don't care. Personally, I would like to have seen them both eligible. But even if they are both ineligible, that would at least been consistent. And that's what we always shoot for is consistency. So here's the payment rates per commodity. Again, soybeans are getting 47.5 cents for every eligible bushel. Corn's getting 33.5 cents for every eligible bushel. And you can see the other commodities down the payments scale as well. But just as an example of how this works, suppose a farmer has 40,000 bushels of unpriced corn on hand January 15th. That represents 40% of his or her 2019 production. He or she has 18,000 bushels of unpriced soybeans on hand January 15th, and that represents 90% of 2019 production. Again, our formula really is, and I've got, the formula is 50% of 2019 production or inventory on hand as of January 15th, and we're going to take the lesser of those two and multiply that by one rate, and then we're going to take that same inventory value and multiply it by the other rate. The simplified formula is just to identify your eligible production, whether that's half of your 2019 production or your inventory as of January 15th, and then take that times those payment rates I talked about on the previous slide. When we pull this in an example, again, here's 50% of our 2019 production is 50,000 bushels or 10,000 bushels of soybeans. Our inventory on hand as of January 15th is 40,000, again, 40,000 bushels of unpriced corn, 18,000 bushels of unpriced soybeans. We're going to take the lesser of those two. So for corn, it's the 40,000 bushel. For soybeans, it's the 10,000 bushel. We're going to multiply those payment rates per bushel. That gets us a total of 13,500 and then just almost $5,000 for soybeans. We'll add those together, but you're only getting paid 80% for your first installment, so that's at $14,500. The remaining 20% will come at a later date. So this is how the CFAP funding works. Just a couple of things. Again, program enrollment started the 26th of the month and runs through August. You can sign up at your FSA office. They are only taking calls. You can't walk into the office, so you can either mail, fax, or email applications. But again, you have a deadline of the end of August to get this in. But then once you submit the application, you have 60 days to get all the other related forms in as well. And so that's that eligible compliance for wetlands and conservation, as well as income, eligibility, and basically a farm business plan. Those are all forms that you have to get in. There's more information and details at CFAP. or farmers.gov/CFAP if you need more details about that. I do want to say a couple of things about two other programs as a result of COVID. Loan forgiveness, or the Paycheck Protection Program, is something that producers are eligible for. There's still money left. As of last week, they'd spent out about a $511 billion out of $660 billion. This is to help producers cover costs for employee payroll, owner employees, self-employed payroll compensation, or non-payroll costs. You have till June 30th to apply for these funds. There was a program change last week to where now you have 24 weeks to spend this loan to get complete forgiveness. So basically, if you use the money that you got for payroll expenses, owner employee take home in the next 24 weeks, you can just completely write that off, and it becomes basically a grant to you. They did reduce the threshold that has to be spent on payroll from 75% down to 60%, which is good for farmers because a lot of crop farmers typically don't have a lot of payroll. So now you only have to use 60% of your forgiveness for payroll to get the whole thing written off. So just something to be aware of, especially if you've got employees. This is something I would definitely take into account. And then the Economic Injury Disaster Loan Program is another program out there to where basically you can get a loan to help you through this period, whether that's fixed debt, payroll, accounts payable, sick leave, other issues of loss. There is a portion of this that is completely waived. You can get $1,000 per employee that you can just waive up to $10,000 if you have employees and you're using the Economic Injury Disaster Loan Program. But again, a low interest rate loan to help with working capital either later this fall or next year as a result of COVID. When we look at other cash flow payments for 2020, these are 2019 ARC County and PLC payments by commodity. I've got corn represented here, but basically you can see the Ohio counties. This is the ARC County program here on the left for corn, and then the PLC program on the right for corn. Again, these are from last year, but will be paid this fall. West Central Ohio saw some pretty significant payments because we saw a big yield decline on the ARC County program, but all counties, if you were in PLC for 2019, you're going to get a payment. Most farmers in Ohio went PLC on corn, expecting big 2020 payments that'll come in the fall of 2021. So that's corn. Same thing here on the soybean side of the equation. ARC County soybean payments on the left, PLC soybean payments on the right. We have not triggered a PLC soybean payment through the history of this program, and we're not expecting to again last year that'll be paid this fall. But some pretty sizable ARC County soybean payments, which is good because we believe most farmers in Ohio chose ARC County for soybeans. We won't get those information until USDA releases enrollment data, but you can see some pretty nice sized payments per acre here in the West Central Ohio region. When we look at wheat, same scenario, ARC County wheat payments here on the right, PLC wheat payments on the left, pretty sizable ARC County and PLC wheat payments together. I don't think you could have made a wrong decision on wheat. However, I do think PLC was a better decision on the wheat side of the equation. And then just finally, there's another program called WHIP Plus, which if you suffered excessive yield loss due to excess moisture in 2018 or 2019, you can be approved for WHIP Plus. There's a lot of programs available to you. This one's ran through FSA. If you had prevent plant or you experienced big losses last fall, this is a program I would encourage you to talk to your FSA office about because there could be some dollars coming to you through WHIP Plus through your FSA office as well. So a lot of farm programs, government farm programs. These are a couple of questions that I get a lot, and a couple of statements I want to make. The question would be, am I going to have to participate even though I do not need the support? I get that a lot. I don't want to participate. I don't need the support. Do I need to participate? Well, no, you don't have to. Nothing's going to force you to. But if you don't, somebody else will. And then that's going to be, people and folks you're going to be competing against for land rent. We know that government payments are capitalized into land values and cash rent. As a result of last year, we figure about 60 to 75% of 2019 farm income came from either MFP, ARC and PLC payments, or CRP payments. And that's going to continue to insulate land values and cash rents. That's why we haven't seen any softness, and I'm not expecting any this year, is because we continue to make up the difference with government payments, and those are getting capitalized in land rents. And then getting a correct corresponding shift in acreage will be slow because of these government payments. We need to reduce acres somewhere in the world. If we're looking at the United States to reduce those acres to match market-based prices, we've got a little bit of an issue from the standpoint that we continue to pay money out, which helps farmers in the short term, but it does not give us those supply responses that we normally see to change to other crops or change out of corn and soybeans to other crops as a result of these government payments. So we've got a lot of resources available at Ohio State for your use. We do these farm office lives is what we call them every second and fourth Tuesday or Thursday of the month. So we got another one this Thursday at 9 a.m. Lots of information about all these programs, and you can find that at goosu.edu/farm office. And it's on my last slide as well. But I do want to finish up and talk about financial considerations for 2020. And I got 3 more sets of slides I just want to break down real quick. Here's my estimates for budgets for corn and soybeans in 2020. And I've got 18, 19, and 20 forecasted here. And again, these are from a representative farm basis. I have 4 representative farms, 2 in Henry County and 2 in Hardin County. And I just want to thank those producers that helped me put these together because they are based on real life scenarios, and it helps guide our conversation as we move forward. But you can see the estimates and budgets items as you move your way down the list. The big one here is if you look at 2019, I had a $20 per acre Arkin County and PLC payment for 2019. Again, that'll be made this fall. I'm expecting closer to a $40 Arkin PLC payment made per acre next fall, so in 2021, as a result of the 2020 crop. And so it's paid on a base acre, so that's why they're the same across all years, both crops is $20 for soybeans, $20 for corn, because it's a mixture of those two that gets us our per acre payment. We had big MFP payments in 2019. Again, that was based on those per acre values, $66 per acre. Following our MFP payments in 2018, which were heavily favored towards soybeans, $107 per soybeans. As you can see, here's our gross revenue line per year, variable cost, everything minus land, basically land and owner take, cash rent per acre, and then you can see the returns per acre between the 2 crops. And so continuing to get worse on the corn side. Basically, we continue to decrease the incentive to plant corn, 52 acre dollar loss per year. Again, that's taking in a $226 cash rent. And this is on highly productive crop land. We see that on the corn side. On the soybean side, we actually increased the incentive this year above last year because we're returning back to a more normal yield. And we saw a little bit of basically improvement in our cost structure. So non-variable costs, again, that's drying cost, other non-land costs, and we saw a big improvement there, which is helping our farm returns here in 2020 for soybeans. So again, if you're looking at corn versus soybeans, if you got any acres remaining, at least planting soybeans over corn seems to be more favorable. However, as we all know and remember from 2019, is that prevent plant corn comes into this equation as well, because prevent plant corn tends to have an incentive over prevent plant soybeans. So if you're planning on planting soybeans over corn, if you're planning on taking prevent plant corn over soybeans, is kind of the general rule of thumb. So I'm going to skip this last poll question too to just my statements here. Is we have seen some change in input costs as a result of COVID over the last couple of years. Debt service is cheaper on lower interest rates. Fuel costs have come down as a result of low oil prices. Land prices are holding stable, which is good because about 82% of our farm assets are held in land. And that's a really good thing to see stable land prices. If those started to falter, I'd be really concerned about our financial solvency at the farm level. I'm very concerned about liquidity at the farm level, but the solvency, if we started to see big increases in solvency, that's when we'd see mass exits and big bankruptcy rates if those land values started to fall. Overall, I think as a result of kind of COVID, here's kind of my estimates on our representative farm panels. At least for last year's crop, I think we lost about $20 per acre in old crop revenue as a result of COVID. Slightly higher Arkin PLC payment, same crop insurance values. Again, that's not including this last round of CFAP dollars. So if you add that in, we're actually, we make that back up. But if looking ahead to 2020, we've lost about $53 per acre in our contribution margins as a result of COVID. between January and now. And then some questions about 2018, 2019 MFP payments. Will we see another CFAP payment in 2020 later this summer? I think it's a possibility. I don't know, how big of a possibility that is, but we've already had the CFAP funding right now based on the 2019 crop only, because it was either 2019 inventory or on hand as of January 15th or 2019 production. Will we see some form of government block grant ad hoc support for the 2020 crop, and that I don't know. And so my last kind of two comments here is land values seem to be holding, which is good. And this was a slide I took from my presentation I gave at the Grain Symposium of Ohio corn and soybean this winter. And Ohio land values actually increased in 2019 from 18. I expect it to be a little bit softer to level in 2020 as it changed from 2019. But a couple of things to keep in mind. For those that are buying land, creating demand for land values, I think you're going to see people being more picky about what they buy, where they buy it, how much is it, does it fit into their operation. Interest rates are certainly low, and that supports land values. But again, we've got a little bit of this uncertainty that's creating people to be a little bit more hesitant about buying land, and I think it's as a result you're going to see people being picky. Supply, the transactions are slightly down as kind of a result of a couple of things. One, we're seeing lower quality land come to market as a result of some of those CRP acres coming out of CRP contracts. And then just, if you're going to sell land, it tends to be your higher tax basis land and higher tax brackets or counties with high property tax rates. And so as a result, that tends to reduce a little bit of the supply of land out there. So again, I think that's all supportive of decreasing the flat land values. When we look at the auctions that we've seen, lower attendance at auctions due to social distancing, either done on line or just fewer people out at those auctions watching land be sold. That creates kind of an interesting balance, because you actually potentially, I'm hearing reports from auction brokers saying that they're getting more outside interest in these land auctions because they are online, and people from other places around the United States or globe can participate in these auctions. Just for the cash rent question, I think a good farm management decision for producers would be to look at those cash rents that they've got in hand. Most of them are set for 2020, but you can start the conversation for 2021. Ask about variable cash leases, taking into account market prices. If market prices don't improve, I'd figure out how way to get those into your cash leases. A lot of people already use variable yields, but start looking at variable prices as well. And then maybe acquire to an owner about adding in a clause in your cash lease or your lease about, with and without more stimulus money. So if we get stimulus money in 2021, my cash rent is this. If we don't get stimulus money in 2021, my cash rent is this. Because basically I'm sitting here looking at 2021 saying, if we don't get some stimulus money for 2020, we've got a big gap between our cash rent rates we're seeing and overall profitability that could cause us some big troubles if those things don't come in. So just something to consider as we move forward. And then just my last slide here on action steps. And these are farm management action steps for producers, but for acres still left to plant, soybeans still pencil out better relative to corn. However, I throw the caveat up there. Remember the lessons in 2019 where basically, prevent plant came as a big role. That incentive to take prevent plant is not as big this year as it was last year. And I think as a result, I don't expect people to use that option if they have the ability to plant. But we saw a lot of support for prevent plant even after the fact with additional programs, those top-up payments through crop insurance, MFP payments, and others of the like. So again, just maybe some planting decisions. If you haven't already, begin marketing the remainder of your 2019 crop for corn and soybeans. I would not carry much of that old crop, 2019 old crop, especially soybeans, through the next couple of weeks. If we get to the end of June, you still got old crop on hand, I'd be really leery about some of your marketing decisions that you make for the 2020 crop, just because you've got so much unpriced still in the bin. But I think most people have moved a lot of that crop, but we have seen some opportunities for relatively strong basis here the last couple of weeks on both corn and soybeans. I saw a picture of one of our ethanol plants, and there was, I guess, probably 100 trucks in line to dump on the day because they opened 25 cents over the July base or the futures contract. So we have seen some opportunities to sell that old crop. I'd consider you to really consider PPP, EIDL, CFAP, WIP Plus, any of those government programs if you're eligible. Conserve working capital at all costs. This might not be the year to go out and buy new equipment because we're going to need to conserve that working capital for later this fall in 2021. You might not want to participate in these programs or think that you need to right now, but given that there's an ending date now, I don't want us to get 6 months down the road and all of a sudden you need support and you didn't take advantage of these programs, and we can't go back, right? That we can't, the deadline's already passed or whatever. They're there. As an economist, I have a whole different set of opinions about these programs of what they do to markets and land values and stuff. But I think from a purely farm management decision is take advantage of these programs if you're eligible, because if you don't, somebody else will, and those are going to be your competitors for land. Adjust your 2020 crop marketing goals to new expectations or lower price. Outside a major weather event this year, it is difficult to see prices becoming overly bullish the next 12 to 14 months. And that's the mentality I use when marketing our grain at home too, is it's hard to get bullish without some type of weather shock. They are expecting a little bit drier weather in some parts of the Corn Belt and those longer term weather forecasts. But, if we produce a crop like what we're expecting and other places come in with strong crops as well, we're going to continue to see challenges on the price side. Keep in mind that if you're worried about selling ahead of time at a loss, to remember to calculate your ARC and PLC income support in. Basically, this is my statement of, I don't want you to miss out on a sale because, the market itself wasn't profitable for you, without taking into account these ARC and PLC income supports. Because if we miss these chances and price continues to go lower, we're going to wish that we would have taken advantage of these now. So I'm just reminding us to make sure to calculate in your 2020, 2021 ARC and PLC income support in your selling practices. And then begin to have conversations on 2020-21 cash rents. Most of the cash rents for this year are already set. Keep in mind cash rents for next year. At Ohio State, we serve both tenants and landlords, so we have to give a balanced perspective. But I think just from a simple farm management decision, if I'm putting my producer hat on, be careful about setting cash rents that are too high just to keep the land. I would be very cautious about those cash rents for 2021 from a farmer standpoint, and look at those variable cash leases for prices, or build in those clauses for if we get stimulus or if we don't. And I think that'll be helpful as we move forward. So I just want to thank you for watching. There's my contact information. I do realize I've gone over and I apologize. There's my contact information. And then just a reminder, we've got another Farm Office Live this Thursday, and then another one on the 25th of June at 9 a.m. at go.osu.edu/Farm Office Live. I don't believe we got any questions in, but I'll leave my slide up here just for a few minutes as we've still got a few people on. And if you have questions and want to email me, I'll make sure and get those. I'll answer your question, and then I'll also make sure and capture that and send that to the Soybean Association and Council so they have the questions and can distribute as well. But again, as always, thank you for watching. I enjoy doing these. I wish we could do these in person. I definitely enjoy live audiences more so than looking at a computer screen, but this is just the environment we're in right now. But hopefully someday soon we'll all be back and we can do live extension presentations as well. So with that, Alex, do we have any questions that came in?
Nope, no questions.
All right. Well, I guess I'll turn it over to you then if you want to end the program, or do you want me to? I'm done. I don't know if Kirk has anything he wants to say as well.
Thanks, Ben. Appreciate your presentation, and want to thank folks for participating today. Thank you.
Excellent. Thank you. Well, this will you guys be posting the slides anywhere if people want to access them? I'm happy to post them on our website at the farm office at Ohio State for people to access them, but I'm happy to send them to the Soybean Association as well for you all to post them.
Let's do both.
Okay, sounds good. So if anybody wants the slides, we've got a couple of places where you can find them. So thank you for your day, and appreciate the opportunity to speak with Ohio farmers. And as always, thank you to the Ohio Soybean Council for their work. So thank you guys, appreciate it.